Chris Matthews, speaking of that scene, Chris Matthews, those of you that watch his show, has a little segment called The Big Number. And my big number, as it relates to Bill's incident, is 2, the number 2. $2 billion. That's how much money was forced upon State Street Corporation, right? $2 billion. That's the amount of money, according to today's Globe, that the entire state of Massachusetts gets out of the stimulus package. So it kind of, I don't know about you, but that's
symmetry.
Huh?
Symmetry.
It's symmetry, yes. I don't know if it makes sense, but it's symmetry. In this morning's paper, you might have read about Moody's downgrading $23 billion in commercial bonds as a first step in regrading or reevaluating a pool of $300 billion in commercial mortgage-backed securities. We're into crazy times. We're lucky to have with us today David Martel, who is the premier broker in this region. I was reading that David has either sold or leased half of the towers in the city of Boston. That's what I. That's
my team.
Oh, it's Dave. So the commercial real estate market until late 2008, early 2009 was perceived to have weathered this crisis fairly well. That appears to have changed. David is going to brief us on what's going on with his company and this important segment of the economy.
Con overstates my significance in the world, I would say, because I remember back in the recession of 89 to 91, shortly thereafter, the reason why I know Con is that he started a consulting firm and put it in a building that I represented, and the market was terrible. And I have to tell you, he appears to be a really fine gentleman, which he is, but boy, is he a tough negotiator when the leverage is in his favor. I want to thank you for inviting me to participate. That's a compliment.
Oh, okay.
Okay. That is a compliment. I want to thank you for inviting me to participate in this forum and to talk about Cushman Wakefield, my firm, and the commercial industry, commercial real estate industry, and how this global economic meltdown is impacting myself, my clients, and the firm I work for. I've titled the presentation, Confronting the Challenges of a Deteriorating Market. And initially, I think what I'd like to do is just give you a little background on our firm, and then get into what's happening in the Boston market, because the Boston market is a microcosm for what's happening across the country and across the world. And I think it will give you a feel that we're in the process of obviously a declining market. Once you understand what's happening in the market, you can understand what's happening to our clients, and in turn, what's happening to us, to Cushman & Wakefield, and firms like us in our revenues. And then once we understand that, we're going to tell you how we deal with this going forward. The first thing I'd like to just give you a quick commercial on us. We are the largest privately held commercial real estate company in the world. If you're talking about commercial real estate anywhere, typically we're in the top 3 of the firms you talk to. We've been around for a long time. We were established in 1917. We've got 15,000 employees worldwide. Revenues in 2007 were close to $2 billion, and in 2008 it was another record. $2 billion was our record year, and then we're a little bit off of that in 2008. 2009 is going to be scary. We are a private firm. We're owned by the employees with a major investor, Eiffel, which is the Agnelli family from Italy. They're famous for the cars that they produce, none of which I have. We're in over 200 countries. We're in every major city in the United States, over 100 cities in the major cities. If there's commercial real estate being traded, and if it's a market of substance, we're there. Our 4 major principal disciplines. Well, first of all, we're an intermediary. We don't invest. We don't own. We advise and get in the middle of deals. We initiate deals and get in the middle of them. Our 4 principal disciplines are brokerage, where we represent tenants and landlords in the marketplace in leasing transactions. We're a capital markets powerhouse. We represent owners, investors, any purchase that's going on in the marketplace. We're particularly strong in Boston. We're in consulting. We provide strategic consulting for large corporations and institutions around the world relative to their real estate. And client solutions, which is really property management, project management, valuation, and appraisal. Our competitors internationally are Jones Lang LaSalle and CV Richard Ellis. Those are the 2 big international players along with us. The difference is that they are publicly traded. But if you're looking at this industry, you always have to look local because there's always a lot of strong local players that are involved, and this market's no different. These are some of the tenants we represent. This is what I do. What I really do is lease space. I help tenants and I help landlords find space or find tenants in the marketplace. There's a lot of big names in here. I represent Bain Capital, AT&T, JP Morgan. But more likely than not, I'm representing a 4,000 or 5,000 square foot law firm. It's the nature of this business in Boston. It's a small tenant market, and that's who we represent. We represent a lot of buildings, including the building you're sitting in right now. We represent Beacon Capital, who owns this building. I happen to be working currently on International Place and the John Hancock Tower, but I also represent smaller buildings. So I work on both sides of the fence, and so does my team of 10 who are involved in the leasing markets. Our capital markets group, if anybody knows anything about Cushman & Wakefield, our capital markets group is the most powerful and dominant in the city. These are the investors, the who's who, creme de la creme in the world. If they're investing in Boston, they come to our offices and meet with Rob Griffin and his team. This is just a graphic showing the towers that we've sold in the last 10 years here. We have our capital markets investment team has a 65 to 70% market share. So it's that kind of information that we bring to the table. This is not only an advertisement, but this here kind of shows what's happened in the world, because these are just transactions that our investment team have done. But notice that really 2005 and then 2006, 2007 were totally different years. What happened was everything was for sale, because that was the era of cheap debt. And that was the era, and we call it the steroid era, because we don't think it's ever going to come back like this. The cheap debt, and then investors who are looking to basically trade real estate like it was a stock, was in vogue during these years. 2008, volume was significantly off. In 2009, it's going to continue to be significantly off, because what we're going to be dealing with is the carnage of 2006 and 2007. I'll talk about that a little bit later. So what does all this mean? Well, what's happening right now for us corporately is our leasing is down. We're not dead, we're down. I can tell you that my personal business is down probably 50%. I believe the first quarter is going to be down 50% year over year from last year. Our capital investment sales group is down significantly. And these are the areas where firms like Cushman Wakefield and CV Richard Ellis and Jones Lang, this is where the biggest margins are and the biggest profits in our business. Our valuation and appraisal group is way up, and the reason why is because the carnage of the last 2 years, the carnage we're going to start seeing now, everyone's going to want to know what these buildings are worth. Our property management is up because we're investing a lot in that, and our project management is basically the same. What we're losing in terms of because of the decline, we're gaining because of the decline. We have a global reach, but local expertise is really where it's at. And really, to understand what's going on with our clients and what's happening with our firm, you really have to understand what's happening in the market. So I'd like you to kind of just think of being above Boston and think of the Mass Avenue Bridge down to the World Trade Center, from North Station to South Station. That's a 60 million square foot market, because that is what I'm going to describe as the rest of the world. That's what's happening here is happening in the rest of the world to a limited extent. And if you were from Mars and you just landed on the Earth and you wanted to invest in real estate, and you looked at this statistic right here, the vacancy rates in downtown Boston at 6.2%, for Class A, which are the towers, buildings like this, or 8.1% for Class B, then you'd think, this is a pretty good market. You'd also look at this and say, the last bit of new supply, new building that was added to the market was in 2004, and then what's being added between 2009 and 2011 is very limited. I mean, basically, you've got 1.2 million square feet. But let me tell you, there's problems on the horizon. Because right now, the availability, overall availability with vacancy is over 8.5% now. That should be changed. But this is the thing to be worried about. Subleases. Subleases come on the market because of tenant distress. Last month, that was 50% of where it is today. And it's coming, and it's growing fast. There's a lot of uncertainty in the marketplace. Bill talks about September 15th, and that was a watershed event in the real estate market. We lag what typically happens in the financial sectors, and I think if you really looked over the last 12 months, there were problems before September 15th in our business, but it really slammed home in September. That's when we really had tangible evidence that income in 09 was not going to be what it was in 08. Okay? And it all comes down, my business is jobs. It's bodies in the seat taking up space in these buildings. And you know, in January, the country lost close to 600,000 jobs. The unemployment rate shot up from 6.9% to 7.6%. Those are significant numbers. Locally, we're not as bad off relative to the balance of the country. These are end of 08 numbers. We've lost 42,000 jobs in 08 in Massachusetts. I can guarantee you that number is at least 7,000 to 8,000 more with what's happened in January. Our unemployment rate is still lower than the national average, and then locally, within 495, we're at about 5.5%. Based upon what I see on the streets, and when I go out and talk to tenants, which is what I do all day long, we think that this number is going to continue to grow. The unemployment's going to grow, and when unemployment grows, space comes on the market and creates problems for landlords and creates problems for the values of these buildings. Most of the high-profile layoffs have been in the financial services sector, which accounts for about 45% of the financial district of the Boston CBD. The other 10%, there's another 9 to 10% which are law firms. But I can tell you that this orange part of the pie chart, there is a significant focus on advertising, accounting, that focuses in on servicing the financial services industry. So if the financial services industry is sick, all the other industries are going to catch the flu, and that's what we're seeing. We're seeing evidence of it now, and statistically, it hasn't really hit the market. Like it or not, this is a market that is driven by a New York psychology. If you look at all the major buildings in this town, most of them have some form of ownership or decision-making power that originates out of New York. And so what we're seeing here is that I can tell you that when I talk to the people in New York who do what I do, or I talk to the owners in New York, the mentality or the mindset, the mood is far worse there than I think it is here. And that permeates every decision that's happening in this town. Because they have such a huge exposure to financial services. We have a huge exposure to financial services also, but we're much more of an asset management-based financial services economy, i.e. Their revenues are in a lot of ways supplanted by assets under management. When assets under management go down, they still get paid. It's not a huge, we don't have a huge trading economy, so when the trading stops, the world doesn't come to an end in Boston. But if you look here, these are the major financial services occupiers in Boston. And what you'll see is the checks here show announced layoffs, and then the light blue checks show subleases. I can tell you that I think every single one of these are going to have the two check marks next to it sometime soon in the future. Okay? Now, there's going to be blood. You talk about September 15th in what happened then, and with AIG, with Merrill Lynch, with Wachovia and Lehman Brothers. I can tell you that the amount of space they actually occupy in this 60 million square foot market is not that big. And there's been very little sublease space that's come out of that. But anybody who doesn't think it's coming is living under a rock. The list continues just beyond what the firms that Bill talked about on September 15th, Fidelity, State Street, Bank of America, Wellington, Bank of New York. Watch them. That's where you're going to see some sublease space coming on the market. Now, when anyone talks to me about Boston, they always talk about Fidelity. Well, this is an interesting slide that I'm not so sure works well in the context of what I just said, because you'll note that when we talk about financial services occupiers of space in Boston, I'm referring to third-party buildings, buildings that investors own. In 2000, Fidelity in the marketplace had 1.6 million square feet of space within 5 blocks of here. Today, they've got 173,000 square feet. What'd they do with all those people? Well, what they did was they moved a lot to Kentucky, they moved a lot to New Hampshire, but they bought 245 Summer Street next door. They single tenanted. They moved everyone over to World Trade Center. Now I can tell you, if they lay off 10, 20% of their workforce, it's not going to have a dramatic impact here, because that space that they're in is nearly impossible to lease, and they're not going to put that on the market. But we're watching to hope that Bank of America doesn't do the same thing, in that Bank of America leaves the market or reduces their footprint in Boston. They've got about 1.7 million, 1.7 million square feet 1.2 million square feet in the marketplace. They're a huge tenant in this marketplace, not only because they're a tenant, because they own one of the most prominent buildings in town. And watch for State Street, because State Street has a huge footprint in not only the financial district, but also in the Back Bay. So when you read the papers and you see that they're laying off, think about me, because that's going to impact my business. But it's not just Boston. We're in a world of hurt. I was talking to a really good friend of mine who works for another firm in Dallas yesterday. I've got clients in London. We've got investors from Brunei. There is nobody, absolutely nobody, that we're talking to that feels good about what's happening in our business. Okay, so what does this mean? Bring it back down to Cushman Wakefield, to Jones Lang LaSalle, to C.B. Richard Ellis, and all the rest of our competitors. Leasing activity is at a standstill. Tenants are paralyzed. If they don't have to make a move, they're not going to make a move. Capital markets activity is virtually shut down right now. There's no capital, and it's impossible to value these assets. Valuations, our appraisal guys, the really smart guys who sit there at their computers all day, they are busy, 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 because there are tons of fights over value, and there's a lot of mark-to-market exercises that are happening. Landlords are worried. The maturing short-term debt forces very difficult decisions, and we'll talk about one of those that's coming up. It also forces a reassessment of value, true value in the marketplace. If there's ever a time you, being a landlord, do not want to know what the value of your building, you don't want your building valued, it's today. Property values across the board, we believe, are 30% lower than they were in the mid-2007 peak, when a lot of these buildings sold. Tenants are worried. The only true prospects who are moving in this market have a gun to their head. It's their lease expiration. Anybody else who can wait will wait, and that is our advice to almost every tenant. Wait. Just why would you make a move in chaos? Most tenants are making the safe choice and staying in place, and many are exploring disposition of excess space via sublease. Vacancies and availabilities are going to rise, and filling those vacancies is going to be very difficult. Now, I'd be remiss if I didn't speak about what's happening at the John Hancock Tower, because that is a huge event, not only in Boston, but in the world of commercial real estate. For those of you who are not real familiar with this is a very prominent building, and this is arguably the best building in town. The owners, Broadway Partners, clients of ours, and good people, let me say that, purchased the building for $1.3 billion in 2007. Lehman put a first mortgage on this at $640 million, and syndicated the first mortgage out to a small group of friends and family. But this is where the issue is right now. It's on the $460 million that is out there in mezzanine bridge equity debt. And what they did is they further, RBS Lehman further syndicated that to a host of investors. I have heard 8, I've heard 10, I've heard 13. whatever it is, Broadway has defaulted on this piece of the debt. And so what happens is it forces a valuation in a market that is a very difficult market to value. So what's going to happen here is that the building is going up for auction on March 31st, 2009. If you look at the paper, that's there. What it's going to do, it's going to force an assessment of where the value is, and it's also going to take a look. It's also going to force whoever controls the building to figure out who's in the money. Which ones of those investors who invested in the debt are going to be in the money, and who's going to be out? Who's going to lose their investment? Who decides this, and who's going to own it? It is an absolute mess, and there's no playbook at this time. I was talking to a major investor in real estate yesterday who said, this is going to be like being in a bar fight with the lights off. Everyone's going to be swinging, there's no rules. And who comes out, it's going to be out alive, it's going to be really interesting. One thing I do know is that when the building gets revalued, it won't be at 1.3 billion. It's going to be low. And what that means is when the value of the building goes down, the landlord can do less expensive rents. And when the best building in town is doing cheap rents, every single building in town, the rents drop. So, is there any reason to be optimistic? Well, I don't know if any of you developers out there, and they hate to see that where it says new construction is dead, but it is for the time being. This is some good news for the marketplace in some ways, because what this is this is going to prevent any new supply coming into the market to exacerbate what's already a tough situation. The reason why new construction is going to be in real tough straits for the next 2 to 3 years is, number one, to build a big building, you need 3 things. You need a big tenant, when there aren't many of those. You need a big tenant that's willing to pay big rent, $65 to $80 per square foot. And I can tell you there's none of those out there right now. And thirdly, you need debt. And right now, we already know that there's none of that. So, where's the market going? Let's look at where it was, where it's been. When I first met Con was in this time frame right here, okay, 89 to 90, 91, 92. That was the first recession that I've lived through. And if you look at the 89 to 93 and the 2001 to 2004, the point I want to make here is that our pain in the Massachusetts economy, Boston, we were down faster, down lower, and it took us a lot longer to come out of it than the balance of the country, which is here is in yellow. Same thing in 2001 and 2004. We had the tech collapse here. We have never gotten back to peak employment that we were in 2000. So what's going to happen here in 2008 to 2010, 11, 12? Who knows? But it's our bet that we're going to track more consistently. Our pain will not be as bad, it will not be any worse than the balance of the country. And I think what you're going to see is markets like New York and big, heavier dependence on financial services are going to be in much deeper trouble. Keep this in mind relative to the next slide, because the next slide here shows you that while we were having tremendous pain, we were adding, at this period of time, 6.6 million square feet of space on the market. More than 6 of these buildings were thrown on the market within a 3 to 4 year period in a market where there was tons of sublease space coming on and tons of job losses. The same thing happened in 2000 to 2004 when we had 5.7 million square feet added to the market. So what it does is it takes the vacancy rates up like this. The other thing to note in building is that the sheriff in town, the most dominant player or owner in this town, in 89 and 91 was the Resolution Trust. And like you said, all they wanted to do was just get it off the books. In this market, it was a REIT, it was equity office, pre-Blackstone. All they cared about, they were a publicly traded REIT. The thing they were focused on most was quarterly income. They wanted income, so they reduced rents to get market share and to get income. Today, these players that are still involved in these buildings, it's a private equity player, Blackstone, and they are still focused on value, still focused on the exit. Where these 2 cycles, that was not the case. Now, whether or not that's going to continue, I don't know. The point on this slide here is where are we going, okay? And you look back and you say, okay, we had a vacancy peak here of 19%, but a rent drop in 89 and 93 of 30%. In 01 to 04, we had a rent drop of 37%. Now, I have taken this, and over the past 10 weeks, I've given presentations to everybody, and I've made predictions, and I've realized that's useless. There's so much chaos involved right now that no one can predict it. I keep having people tell me, look, what you're missing is, it's not 89 and 91, it's not 2001 to 2004, this is 1974. I have no concept of 1974, other than the fact that I was playing wiffle ball in my backyard. But what I will tell you, I do know, is that the psychological bottom of this market is going to be in the fourth quarter of this year. How long it's going to stay like that, I don't know. I think the statistical bottom is going to come a year later. But if you're a tenant and you want to make a deal, this is the time to do it. Anytime between there and there, because it's going to be a great, great market. There's going to be great opportunity. So it's going to get worse before it gets better. Subleases and defaults are going to make it a very difficult situation worse. The supply will come in small slices spread out over a lot of buildings. That's trouble. More choice for tenants, more problems for landlords. The landlord angst will escalate. Panic pricing is possible. Rents are going to decline, but I'm not sure it's going to be worse than in previous recessions, and no one is immune. So what does this mean for people like us, for Cushman and Wakefield, for the commercial real estate industry? There's no question. Fewer transactions, lower revenues, and lower profits. How do we confront these challenges? Limited retrenchment. The talent that our firms have are guys like me on the street digging up information. If you cut people like us, like me, then what happens is you lose our business, the commercial real estate industry loses the connection to the street in everything they're selling to the clients. But like all companies, they're watching expenses incredibly carefully. They're cutting industry events and charitable giving, and there's been a few administrative assistants and marketing people. If we're really in dire straits, watch when they start cutting finance people and non-producing brokers. When brokers start hitting the streets, that's when you know our industry is in really, really tough shape. So, there's a mantra, as you can imagine, with revenues being down, the people who run our companies, there's not a lot of happiness there. But what they're telling us is, this is and I agree with them, this is an extraordinary opportunity to gain market share, and they want us to be as optimistic as possible, to resist the tendency to be a victim and to be relentlessly focused on understanding what's happening on the street, and then get in front of your clients and hold on to them as long as you can, because when they're ready to make a decision, they're going to use us. So it's a great business. It's just a tough time.
Great. Thank you, David. I guess we were all brought into the club that David exists in, because listening to him and watching all the slides, I was hardly feeling optimistic. And then to find out that the #1 bullet, the exhortation from the company, is to be optimistic. I guess we're all brought into the inner circle in that regard.